Welcome back to Finishing Well with Certified Financial Planner Hans Scheil. Today, we're gonna, at some point in time, you got to talk about leaving a legacy. What does that exactly look like? And Proverbs, Solomon was a pretty wise dude, even though I didn't think did they have life insurance back in Solomon's day? But anyway.
I think they did.
Proverbs 13:22 says, a good man leaves an inheritance to his children's children, but the sinner's wealth is laid up for the righteous. And I believe that Solomon was talking about more than just money there. He's talking about your name. He's talking about certainly the kingdom of God and what you're leaving your children. But there's part of that as well. And Hans, I really see that my father is a picture to an extent of my heavenly Father, of him being concerned of planning on how I'm going to be taken care of as far as my inheritance. And I've always known, my father's always been very careful to tell me, this is the way this is going to work, this is where these forms are, this is the plan, this is what you're going to inherit. And I've always had a sense of, wow, my heavenly Father's going to make sure that kind of plan's there too.
Sure.
And it's a picture of that.
Sure it is. And I think your father sounds a little bit unique, because I talk to a lot of people, bringing in clients. I'm working a lot with children, and as we talked about on an earlier show, we run into a lot of folks that haven't really planned their inheritance they're going to leave, or planned their estate. They haven't even looked after very well how they're going to be looking after, taken care of while they're still alive, like long-term care and paying their bills and all that kind of stuff. And I think that's great, and I commend your father. And for you listeners out there that really have sat down and planned this stuff, I commend you for that as well. And it's a little bit ironic that a lot of those people listening, you want to hear more. You're on the show today, and you want to hear what I have to say about that. So when we're talking about estate planning and life insurance, what we're going to include in there is not only planning for after you're gone, but let's plan for the couple, 3 years, 5 years, 7 years, 2 months. I mean, some people are real fortunate that they're healthy all the way up until a little bit before they pass away, and then they're gone, and they don't really need to worry about somebody caring for them. But most of us are going to have some period of time where we're not able to care for ourselves. That includes your financial matters.
All right, so that person that ends up having Alzheimer's, and they're no longer able to open their mail or care for themselves, and there's planning that goes in to make sure that your family doesn't end up having to pick up the ball on that.
Absolutely, and it's tied in with your estate planning. So when we talk about estate planning, we're going to say that your estate is everything that you have that's of a financial nature, okay, or real estate, money in the bank, and some of those debts. I mean, all that stuff that's mixing along that you're living off of. And then we're going to include the time period that most people, when they think estate, they think, okay, so I'm gone. And then what's left? What do the survivors get? Okay. And that's certainly what we're here to talk about, but we're going to include the period of time before your death where, from a financial standpoint, you need somebody else doing it anyhow. We're going to cover a pretty wide period.
Right. So there's some stuff that people, and you said that everybody that breathes essentially ought to have some documentation. What do you?
Well, I mean, you were saying before the show when we were talking, you said, at what age should people do this? And I said, all the listeners need to do this. I mean, what I was just saying is you can't do this young enough. And if you did it at 50 and you're now 65, you probably ought to check in on all of it again and again. You really need to look into this about every 5 years. So there really isn't a best age. The sooner the better. And you're going to feel unbelievable. I mean, what I can tell you is when people do estate planning and they get it done, and it's kind of been on everybody's list. I mean, most listeners, if I'm in touch and this is kind of on one of those lists of something that you and your spouse, I mean, you know you need to do this, and when you get it done, you're just going to feel great.
Yeah, even if you're in your 20s, were you in some type of horrible accident, how do you want certain things to be handled? And all those things are all fit into every demographic.
I can just tell you, if you're listening and one of your kids are in their 20s, so now they're an adult, if they have a horrible accident and they're still alive, and you now are going to go in and care for them, your child and you love and you care for, you're going to have a hard time legally dealing with the doctors, dealing with the lack that you don't have a healthcare power of attorney. And then if they do pass away, just dealing with their estate. I mean, there's no bad age to get this done. I mean, the fact remains most kids in their 20s are not going to go do this unless their parents go do it for them. But just using that as an extreme point, if you're of child, where you have minor children, you really need to go do this stuff. Okay.
And so to do this stuff, what does that mean? What's the stuff we need to do, Hans?
Okay. I mean, at a minimum, and I say this in my book and the workbook, you need 4 documents at a minimum. Okay, you need a will. I mean, most people understand that, what a will is. You need it done in the state where you live now. Pretty simple. I mean, you can print out some wills online. I mean, you can actually, you need to have something written down that tells the people that has a legal effect. I mean, most people already knew that. You didn't have to tune into the radio to get that. I would recommend that you would do it at an attorney, okay? The second thing you need, while you're still alive, just planning for that period of incapacity, if it happened to you, you need to give somebody power of attorney. And to some degree, your spouse has this if you're a married couple, and a lot of people just rely on that. If something happens to me, she'll go in there and take care of it, or vice versa. And it kind of works. But, if both of you are gone or you're a single person, you have a hard time going and just even paying a bill for somebody or calling up a financial company. So you need a durable power of attorney. Again, you can get something off a line for that. I'd recommend going to an attorney, okay, that specializes in this kind of stuff. Third thing, you need a health care power of attorney, and that's separate. And what that simply does is it gives another person power to make health care decisions for you, to talk to your doctors, to make a decision. Should we go to this nursing home or that nursing home? Should we get the home health care 7 days a week or 4 days a week? Should we use this agency? You can engage in a contract with a health care agency, okay? And just various things from a medical standpoint and a health care standpoint that when you can't do these things for yourself, you need another person or persons with the legal authority to do that. And then the fourth document that you need is you need a HIPAA release. And people say, I already signed that down at the doctor. Yeah, you did. The doctor had you sign his or her form and then gives them the right to give certain people your medical records. But that's not going to do you any good if you're over at the hospital or somewhere else and you can't sign for yourself. What I'm talking about is just a HIPAA release that gives this other person, probably the same person as the power of attorney, the ability to get any medical records, see medical records, that kind of stuff. So it's really 4 documents, and we have an elder law attorney, at least in North Carolina, and we have 3 offices. We've got an office in Raleigh. We've got an office in Greensboro. We have an office in Charlotte. I divide my time but amongst those. She can't practice outside of North Carolina, but when we find somebody that we're doing business outside, we find them an attorney like her, and she specializes. You don't want to go into an attorney and start asking for these things. If you have to explain to them what they are, you show them my book, you don't want to go to that attorney. These shouldn't cost you $500-600 for the whole package, okay? And even for a married couple, okay? Now, that may sound like a lot of money to some of you. Trust me, that's nothing, okay? Now, you may need more than that for estate planning. You may need to set up a trust. There could be but just as a minimum, you're going to be doing your family and your children, you're going to be giving them a real gift by getting those 4 documents in place and then keeping them updated.
Yeah, because the legacy that you're leaving is, oh my God, when my father or my mother or my sister died, I ended up with this, catastrophe of how do I do this, how do I do that, how do I get through that? And again, it's kind of part of your inheritance is what you're leaving. But that leaves another aspect of what we're talking about today, right, Hans? Which, by the way, you're listening to Finishing Well with certified financial planner Hans Scheil. And the Cardinal Guide is the sponsor, which we always want to remind you, you can go to cardinalguide.com to find all the resources, podcasts of previous shows. You can download the worksheet that has all these forms that Hans talking about right there at the 7 worries. You just go on, this is the life insurance estate planning is the name of that.
That's
particular
correct.
book. And so you can go get the PDF of that. But this whole idea of life insurance, I mean, for me personally, one of the things I really praise God that somebody put somebody in my life when I was younger to talk some sense into me on one of these things, one policy that I bought years and years and years and years ago. I can't thank God enough because, as time's gone on, it's just paid dividends after dividends. And so it's not always just term insurance. You may know a little bit about life insurance. There's all sorts of things out there and wisdom that goes along with that, right, Hans?
Listen, a wise man once told me, Johnny, my nickname is John, and, they called me Johnny when I was younger. I was selling life insurance at 18. He said, talk to these clients about what life insurance does and stop talking to them about what it is. We could talk all day on all policy provisions, loss ratios, reserve. We just talk about all kinds of boring stuff. Talk to them about what life insurance does, and it creates money, an explosion of money at exactly the time it's needed to look after your loved ones. And so, what's there not to like about that?
Yeah, and it's a very interesting provision that's out there for anybody that's ever received it, and there's tax implications with life insurance too, right? Like you had said earlier, one of your favorite things is to get money without tax, and life insurance is one of those things, isn't it?
Well, it sure is, and I want my children and my wife to receive this money after my death, especially if it's an early death, that just tax-free. With the stroke of a pen, a life insurance person like me can create an estate just about any size that you want. So, like when you're young or middle-aged and you haven't really accumulated yet enough to take care of your loved ones after your death, you could sit down with a life insurance person and through a whole list of different policies, but you get a good recommendation. With the stroke of a pen and a small down payment, you can create an estate.
All right, we've got so much more coming up today on life insurance here on Finishing Well with certified financial planner Hans Scheil. When we come back, life, what? Certified financial planner with cardinalguide.com. We've been talking about estate planning and life insurance, but Hans, your book is called The Complete Cardinal Guide to Planning for and Living in Retirement. So I always heard that you don't need life insurance once you're in retirement. After all. So what in the world does that have to do with all this?
Well, it has a lot to do with it.
Or as I said right before the break, life what? I couldn't need that now, do I?
I think what you're referring to is that most folks, when they're getting started out in the world, they buy term insurance. And you have very little assets, you've got a lot of liabilities, you've got young kids, and it's a wonderful thing. It's really a miracle where a person that has bought term insurance and then they pass away and a huge amount of money goes to the widow or widower and takes care of the kids. It's wonderful. And people that do that, and it takes care of you while you're young. And then it comes to an end, or it's a 20-year or 30-year, and then maybe you renew it for 10 years, and so you're just working under the common wisdom that through my working years I need life insurance, and then when I get to be 65 and older and I'm retired, I don't really need it anymore. And what I would say to that is, who's going to suffer a financial loss with your passing? Okay, I'd ask you to ask yourself, what kind of situation would I be in, or would, obviously, if I'm passing, my situation has got other issues that my survivors left in. What, they obviously have to pay for a funeral. Okay, Those are very expensive these days. A lot of folks say, well, I've already paid for all that. Okay. And we can talk about that on a subsequent show of whether
Yeah, I
that's
can
a
assure
smart
you,
idea.
you may think you paid for it all, but they will find you if you've been through that, and I have a few times. Oh, well, that doesn't count for actually digging the grave and actually doing that. You know, they got about
sure.
4 or 5 things that they're going to hit you with.
Well, yeah, and not only that is that if you've already prepaid it, there's no shopping left. I mean, so there's advantages to that. If you've got a life insurance policy, even if it's a small amount that goes to your heirs, and then you've gone and set it up, they can at least shop and they can have some control over the bill. But in any case, that's going to need to be provided for. If you've got a will, which we talked about in the first part of the show, that's going to need to be probated. You're going to need to pay an attorney to do that. Your accounts are going to be locked up unless you're married and your spouse survives. I mean, they're going to be able to get into the account, but they're going to have to pay the attorney, pay the funeral home, pay the expenses, pay the bills. One of the Social Security checks is going to go away, or if you're single and you pass away, the Social Security check's going to stop, and one of your children, if they're going to keep paying the bills for the household, I mean, it takes a while to settle a person's affairs, so you're going to have to do that without one of the big sources of income, the Social Security check. You're going to have to get into some accounts that it may be difficult to do. And so, I mean, we could sit here going on and on and on and on. A retired person needs life insurance. And what I would say is a minimum of $25,000. Now, immediately people are going to say, look, I can't afford $25,000. Well, it's going to be better to buy 10 than have nothing. So, and that's going to take care of a funeral, and it's going to be something there. But when I say a minimum of $25,000, in my book, I talk about that. That's going to give $10,000 for the funeral. It's going to give $1,000 a month for 12 months, $2,000 a month for 6 months to replace that Social Security check, and it's going to leave $3,000 to pay an attorney for estate settlement. And the check's going to go directly to the beneficiary. It's not going to go to the attorney. It's not going to go to the estate. You can name your daughter or your son or your spouse first. There'll just be a check that'll come down from the life insurance company. You don't have to go to any attorneys. They have free reign over it. They can go shop for the funeral. They can just do all that kind of stuff, pay the bills out of there. Well, the attorneys are mucking around with the estate. So, that's kind of a quick answer, but a long answer to your question. When you're in retirement, you need life insurance, $25,000 at a minimum. A person that has more substantial assets, we may be talking $100,000. Okay, a person that's still bringing in an income, even if it's a small income, a lot of retirees have part-time gigs these days, and a spouse who's not doing that or a spouse who's sick, we can get up in the $100,000, $200,000, $300,000 department. And by the way, it's very possible and probable to write life insurance on people in their older ages. It was very hard 30 years ago. I mean, you get somebody 70 years old wanted life insurance other than a dinky little amount. It was very hard. Now, we do it all day long. We're writing life insurance for people in their 70s and certainly some in their 80s. I don't think we write life insurance on people in their 90s. But we go all the way up to age 89, and we've written a number of policies on people in their 80s, people your dad's age.
Right. And so when it comes to life insurance at that age, is it still, I know there's different kinds of life insurance. Does that apply at all, whole life versus universal or any of those things?
You really don't want to be buying term insurance in your 70s and 80s. You might want to buy it in your 60s. I can think about like a couple. We have a lot of couples just getting married, in their 60s, where they've either lost their spouse through death or divorce, and they're coming together, and then you've got estate planning considerations where her kids, when she dies, are looking for the inheritance that came from their original dad or vice versa. You got a lot of estate. But when it's all said and done, we use life insurance, and a lot of times we'll use term insurance with them because they need a large amount of insurance for the first few years of that marriage. Over time, those assets will fuse together, and everybody kind of becomes everybody's kids and grandkids. But in the beginning, or the first 5 or 10 years, term insurance can be used to create an immediate estate for the new spouse. But still, in their 60s, most of the people that are sitting down buying this stuff now, they need to be buying whole life insurance. They need to be buying something that's going to pay out no matter what age they die. Okay?
And so you can still buy whole life insurance policies at age 70 then?
Absolutely. And universal life, which universal life are really whole life policy. They just have a flexible premium. So you want to buy something that is designed, I mean, you hear the word whole life, that means that's in force for your whole life. Okay?
Oh, like WHOLE?
Yeah.
Not like you got a hole in your life. Okay, I got it.
Yeah, that's it. And so if you're buying this thing at 67, you want it to pay out if you die at 92, or if you die at 72, you want it to pay out. So there you go.
So again, or just for our listeners, that they may not even be familiar with what that means, whole life. And so what that means essentially from what you're describing is that the payment's not going to go up every year as you get older. If you got a whole life policy at age 70, you set it up at a payment. You're going to pay that even if you be 180.
That's exactly what it means. The payment doesn't change. The insurance doesn't change. And it's guaranteed to be enforced when you're deceased, as opposed to term insurance. Term insurance is just what it says, for a term, like 10 years, 20 years. If you die during the term, your beneficiaries get the money. You die after the term, they get nothing. So if you're buying as an older person in retirement or approaching retirement, you want to buy some life insurance, if you buy life insurance, that's going to be in force for your whole life.
But when I think of whole life insurance, I also think of cash value. So is that something that's happening then for those policies for somebody in that age bracket too?
Well, it is, but they have a new type of policy.
Oh, really?
Okay.
See, here's where
that accumulates minimal cash value, but it still has the guarantees of the protection for your whole life. It's called Guaranteed Universal Life Insurance. So GUL. I don't want to get too many confusing with too many, but there's a life insurance. Life insurance is a lot less expensive to buy. We're going to use another word called permanent life insurance. So it has minimal cash value in the early years. In the later years, it's going to have no cash value, but it's going to have a huge cash value for your beneficiaries when you pass, no matter what age that is.
So that's the difference. So that helps me understand. So I'm thinking gull here.
Sure.
That this is a really a new product that hadn't been out there because, back when I was thinking whole life, it was all about the cash value and that kind of thing. But here's a way that they've been able to bring down the premiums is to not have that part of it.
That's exactly right. And there's another thing out there called single premium whole life.
Really?
And so, yeah. And
I'm guessing you just make one payment.
Boy,
I like that.
You are a smart man. Okay, and I've got an example in my workbook, which you can download these chapters of both the workbook and my original book at cardinalguide.com, or you can buy the book on Amazon, The Complete Cardinal Guide to Planning for and Living in Retirement. On page 90, it shows a 70-year-old female can pay a single premium of $15,432, and she's guaranteed a $25,000 life insurance policy at her death. Okay? Never make another premium. So you say, well, why would I want to do that? Well, look at the increase you've gotten on that if you die, and it actually could end up paying out more than $25,000. I don't want to get into technicality, but the $25,000 is guaranteed, and you can name a beneficiary. This money will stay completely out of your state. You could name your church as the beneficiary to this.
So if I'm guessing right, this is one of those places that really you've got this alphabet soup you talk about, where maybe you use your IRA or some other thing that you've got as part of your estate to make that single payment.
Sure.
To set up a large estate for a particular situation that's in that where, like you talk about, in your situation, you need this kind of policy.
Yeah. See, what I want you to understand is beneficiary designations, named beneficiaries on a life insurance policy, trump the will. So when you name your church as the beneficiary, you name your daughter or you name your nephew, when you die, the nephew is just going to bring me a death certificate, or whoever's handling your affairs, and we're going to send it in to the life insurance company, and they're going to send the check made out to him. No lawyers, no estate, no probate. So that's another reason why you want life insurance. It creates immediate liquidity right after your death.
Right, and it's a way to spend some of those IRA taxed money and turning it into untaxed money that's really cool. I know all this stuff comes together, and I'm thinking,
we got to go
wow.
through a few motions to get IRA money into here. So just with that's a good thought, but I don't want a listener to think, oh, I'm just going to put my IRA into a single premium. We got to go through a few steps, and we got to pay some taxes before we get that done.
Yeah, that's all got to be a part of it. So, you can see that this is all part of, how wonderful is it to sit down with a brother in Christ and be able to just go out there to cardinalguy.com. You can contact them. As Hans talked about, they spend time in their office in Greensboro, their time in our office in Charlotte and in Raleigh, and they're easily contactable from the website there, cardinalguy.com, and the phone call is absolutely free, right? You don't charge.
Yeah, we have all kinds of clients in California that we never met. So we deal with people all over the country. We're licensed in all the places. And I'm getting old, man. I mean, it's great when I can stay in my office and take care of a
Don't
client
be saying
right
that
from the
at
chair.
59, Hans, really. There's a lot of people listening that are saying you're a kid. So you've been listening to Finishing Well, and that's all part of it. Finishing well, leaving, right, a legacy, leaving, an inheritance for your children's children. Because God's all about, how many times did he tell Israel that they were going to get an inheritance? And so this is something that really we want our children to feel like that we've done everything we did to plan well and do those things. What a resource you have at cardinalguide.com along those lines. The book, as we've talked about many times, The Complete Cardinal Guide to Planning for and Living in Retirement, and the accompanying workbook. You can get them there, download them for $2 for the ebook. Thank you, Hans. It's been a lot of fun again today.
Yeah, thank you.